Good morning. I'm Louise Forrest, Head of Banking and Finance at Winkworth Sherwood. I'm very pleased to welcome you to our ESG panel discussion this morning. A little bit of housekeeping. The attendees' videos and microphones are switched off, but we welcome discussions in the Q&A box throughout. These will be answered at the end of the session. A recording of the webinar will be sent out to everybody afterwards. To briefly introduce our panel, we're very pleased to be joined by Martin Watts, Director of Treasury at L&Q. L&Q is one of the UK's largest housing associations, owning and managing more than 100,000 homes. Martin is a vocal and experienced voice in the sector and has significant experience of ESG, having led L&Q into one of the sector's first sustainability-linked loans. Martin is focused on developing L&Q's strategy on ESG. Rob Griffiths is the Deputy Chief Executive and Chief Financial Officer of Longhurst, one of the leading housing groups in the Midlands and the South East of England. Rob is an influential voice within the sector and the current chair of the Housing SORP. Rob has also led and been involved in a number of key growth projects at Longhurst and is now looking to develop Longhurst's ESG strategy going forwards. Phil Jenkins is the Managing Director of Centris. Phil is a founding partner of Centris Financial Advisors and draws upon 20 years' experience of structuring finance facilities. Phil played an instrumental role in the development of the Sustainability Reporting Standard for social housing and has been very involved with developing ESG compliant facilities in the social housing sector. Chuka Ramuna is the Managing Director and Head of EMEA ESG at JP Morgan. Chuka joined JP Morgan in April this year to develop the bank's ESG strategy across the EMEA region, helping the bank and its clients to integrate ESG into their operations and business activities. Chuka was previously the Member of Parliament for Streatham from 2010 to 2019, serving in a number of senior roles in the House of Commons, including as the Shadow Secretary of State for Business, Innovation and Skills. Chuka has significant experience advising corporates on managing ESG issues, including as a corporate employment solicitor and as a non-executive director of several UK companies. I will now hand you over to Sarah Williams, who's kindly agreed to chair today's session. Sarah is the editor of Social Housing, the sector's finance magazine, having first joined as deputy editor in 2018. The publication has led on coverage of ESG finance within affordable housing, including breaking the news of the initiative to create the now launched Sustainability Reporting Standard for social housing, as well as a number of sector-first ESG finance deals. Thank you very much to our panel. Sarah, over to you. I am very much looking forward to hearing the debate. Thank you.
Thanks, Louise, very much for that introduction. And I'm delighted to be here to share the discussion with such an expert panel. As you say, I joined social housing just under 3 years ago. And even in that time, through my conversations with housing association finance leaders, ESG has gone from what seemed like a relative niche, a special interest project for a handful of keen beans, to becoming a term that crops up in almost every discussion that we have and deal that we analyse. Last month, Social Housing published our own analysis highlighting that just looking at the capital markets, ESG-wrapped issuance by or on behalf of housing associations now exceeds 4 billion, helped slightly by the 1 billion of bonds retrospectively labelled as social by one of the aggregators, but also by a huge flurry of sustainability issuance during this calendar year. And in total, associations have issued more than 2 billion of own name sustainability bonds to date. So with that short backdrop and with such a great lineup of speakers who, as Louise has outlined, come at this from a variety of angles, I'm eager to kick off our discussion with some initial questions to our panelists, but also to come to your questions as we go through. So please do send those in through the Q&A box and I'll field them to our speakers at the end of our initial discussion. So to start us off, I'm going to come first to Phil Jenkins with this opening question. Phil, what is the scale of the opportunity for the UK social housing sector where ESG finance is concerned? And is it just about access to funding or more than that?
Schoolboy error. I'll start again. Thank you, Sarah, and morning, everyone. Very nice to be here talking on this subject today. So I think it is a much broader opportunity, and I think prior to the the work that's taken place over the last couple of years around sustainability-linked loans, sustainable bond issuance, and indeed the sustainability reporting standard for social housing. The housing sector felt like it was sort of lagging behind in reporting terms the reality of what it was delivering on the ground. And I think, in many ways, this whole sort of area initiative is a great opportunity for the housing sector to really sort of showcase the work that it does across each of these areas. I think, obviously traditionally it's been very strong in the in terms of sort of the social and governance aspects of this, but increasingly environmental is becoming sort of front and foremost of the work, particularly on around new development and retrofitting going forward. And what the sustainability reporting standard did was really sort of take everyone to, or the attempt was to take everyone to what we described as sort of base camp or sort of basic hygiene standard of reporting on ESG, and gives the framework for organizations to be able to sort of report on a consistent basis across these areas. And we always said that from that base camp, some organizations might stay there, based on the resources and needs of the organizations. Others will go on and develop this into our other areas. But I think what it's also done is facilitated a much bigger conversation across organizations. And I'm sure, Martin and Rob will sort of attest to this, that, the conversation has opened up between sort of finance and treasury and other parts of the organization in a way that it didn't before. Everyone was sort of operating in their little bits to some extent on this, and is really sort of helping to, finance is helping to unlock organizational change and a recognition that it's not good enough just to sort of be doing this stuff. You've got to actually be able to measure it and to communicate that to a range of stakeholders as well. So I think the answer is yes. I think there is a much bigger opportunity than simply what you see on the face of it around the financial markets.
Brilliant, thanks for that. And I'd also like to come over to Chuka with that question, coming at this sort of from a broader perspective, what you see as the scale of the opportunity for social housing in the UK specifically.
Well, first of all, thanks very much for asking us to take part in this webinar. Extremely timely, and in short, it's a huge opportunity for the sector. At JP Morgan, we, in terms of our debt capital markets team here, we're the lead global book runner on green bonds and have a leading position on the issuance of other ESG, DCM products. And we talk to investors obviously all the time about what it is they are looking to invest in. And one of the things that is quite clear across the whole suite of ESG issues, equity and fixed income products that speak to the desire to invest in ESG products and companies and corporates with a good ESG profile, is there's huge demand. And I'll just go through some of the figures for this year, which are breaking records. But a strong feature of the feedback that we often get is that there's simply a lack of investable assets out there to meet this demand. And clearly, if you look at the types of business activity that investors are looking to invest in these days, then social housing providers tick a lot of the boxes. Now, we think that there's obviously a lot of activity. So this year so far, we've had $245 billion worth of green bonds issued, $129 billion worth of social bonds, and $83.8 billion worth of sustainability products. We think there's probably more growth in the social part of this. And there is obviously an opportunity because, what the sector is doing is deeply social. Full credit to Phil and all the others who worked on the sustainability reporting standard for social housing, because it is constructed in a way that it conforms with many of the global standards and frameworks that investors expect issuers to comply with. In particular, SASB is, if you like, the preeminent global standard but when it comes to investment and when you're looking at financial materiality, GRI as well is particularly relevant for some of the impact funds who look at double materiality, not only the extent to which ESG helps drive value, but also how it helps drive positive outcomes for society. Now, the way that the new reporting standard has been composed is such that essentially it aligns with both of those key global standards and also, of course, the UN SDGs. So I think the starting point here is a strong one. And, you know, there is a huge potential for the sector to take advantage of what is going on here. And the last thing I'll just say, at risk of conforming with the stereotype of a boring windbag ex-politician, is that never forget what, you know, has driven a lot of this before the impact of COVID and how it turbocharged the ESG investing marketplace. You know, so much of what has changed investing practices here is the changing demography of asset owners that asset managers are accountable to. And we've got this enormous asset transfer ongoing from the baby boomers to millennials and younger cohorts. And there are various different figures, but there's certainly a consensus view that we've seen over $30 trillion worth of assets making that move. And these younger investors are saying, you know, in some of these high net worth families with a lot of money, look, mum and dad, I'm happy for us to invest in things that deliver greater value. Of course, that's what we've got to do with the family savings, but I want it to adhere to our values too. And they care about equality, they care about the transition, they care about whether it's a just transition. Now, in all of those respects, there's a huge alignment between this sector and what these new investors who are changing the whole nature of in the investing landscape, what they want. So that ultimately is why there's such a big opportunity here.
Brilliant, thank you, Chuka, for that. And you spoke there about the changing demography and how that is driving change. But I also wanted to stay with you and ask a question about to what extent regulation and government policy is already dictating what ESG adoption looks like. You spoke about some of the standards there, but whether you see that increasing in the near future as well.
So I think what's been so encouraging about this, look, if you look back, 9-10 years ago when I was serving as the UK Shadow Business Secretary, and I would have CEOs of, and chairs of different sectors trooping in and telling me essentially that anyone who was making the case for the stakeholder capitalism agenda, which is at the root of what has spawned into ESG investing, we were being treated like we were like pseudo-Marxist radicals for coming out with this stuff. And, ironically, some of the very same people who were, giving it with two barrels to any notion that stakeholder capitalism should take hold are now giving, speeches at Davos when Davos used to meet in person about the, the merits of stakeholder capitalism. So there's definitely been a big mindset shift, but actually, I think in many respects, it's been driven more by the market than it has by public policy. And, if I just give you an example of the US less so than in Europe, but we've also seen it happen in the US, has seen record inflows into ESG and sustainable funds, record volumes of all the different ESG debt capital market products being issued. And that has come about over the last 3 to 4 years, principally under the most anti-ESG American administration you could see under Trump. They actually actively sought to thwart ESG investing. And in spite of that, you saw this big, inflow of funds into the ESG space. So I'm not saying that public policy doesn't matter and doesn't help shape markets, which it does, but the market ultimately has been moving because asset owners have been demanding it. Now, if you look ahead, undoubtedly, as I said, regulation does create markets. You create an incentive for whether it's a social housing provider or another type of corporate to do things which they otherwise wouldn't have to do and therefore have to allocate capital. And in the UK coming down the track, there have been slightly contradictory noises from the government in the sense of, to start off with at the beginning of the year when the Chancellor said post-Brexit that we would, broadly speaking, adopt a taxonomy and a disclosure regime similar to the EU's EU taxonomy and sustainable finance disclosure regulation. They're now talking in terms less in terms of aligning with Europe, more in terms of aligning with best practice wherever it may come. Now, in practice, for people in this sector seeking to issue debt, if you want to be able to tap investors to basically take on the debt, you're going to, in the EU markets, you're going to have to comply with the EU regime in any event. But here in UK, they are, I'm not going to knock the government because I think they're actually doing pretty good things. As of the beginning of this year, premium listed companies, the FCA were requiring to state whether or not they were going to comply with the Task Force for Climate-Related Financial Disclosures, TCFD, whether they were going to comply with that, and if not, you had to state why not. There have been new obligations on pension schemes, with more than £5 billion in funds, on banks, on insurance companies, to comply with TCFD. They'll have to do that at the latest from October this year. Small pension schemes and others are going to have to be doing TCFD disclosures from 2022. We at JP Morgan, we've just advised the government, and we're the structuring agent and responsible for drafting the framework on the inaugural Green Gilt, which is being the first tranche of which is going to be issued in September. So they are, seeking to do things, and all the actions and measures that they're taking, whether it's funding wise or in terms of regulation, is going to drive the need for allocation of capital, is going to drive more investors to look for the kinds of assets which conform with what is needed to attack society's problems, particularly climate change and equality. And if you have deals that's structured in the right way from this sector, then you're going to have investors seeking to get the product, because asset owners and their ultimate clients are looking to invest in these types of things.
Brilliant, thanks so much for that, Chika. I'd like to come over to Martin for his thoughts on that point of, sort of potential for more regulation coming down the track in future. And then I'll move on to another question that I've got for Martin as well.
Thank you, Sarah, and good morning to you all. I totally agree with what Chuck has just said here, and I guess the first thing we need to do is distinguish the question. There are two different aspects that apply here. There are those regulations that apply to the market as a whole, and then there are those measures that relate to how ESG related projects can be financed. The two acronyms there being greening finance and financing green. So yes, we've seen the EU taxonomy regulation and sustainable finance disclosure regulation coming in for asset managers. To date, that has had limited impact on issuers, but we've got to recognize that we're still at an early stage, and investors are starting to contact issuers directly to request taxonomy related confirmations. My view there being that comfort should be provided by periodic reporting, and therefore that probably links nicely back to Phil's point and what the work that has been done in terms of disclosure from this sector. I guess going forward, the point around for premium listed commercial companies to comply or explain, whilst at this stage this does not extend to issuers with debt securities admitted to the official list, that may change in the future. And I think that the FCA has asked market participants for their views on whether to apply TCFD aligned disclosures and how best to do that. The point around individual transactions, the starting point on that is really the ICMA principles and recommendations. And whilst ICMA is not a legal requirement, it certainly carries persuasive weight. And what we can see with ICMA guidelines is that they are regularly updated. And if we look at some of the most recent updates, the recommendation to look at external reviewers and verification of internal reporting. Whilst it's not a force of law, I think that that will continue to be highly persuasive. So my view here is, yes, in future, I definitely feel that there is going to be more regulation. And where does that particularly hurt us as issuers? Well, it's through the documentation that needs to be put into place. And what's really interesting right now in an early stage is the use of proceeds kind of documentation feels a bit simpler from a regulatory perspective. But if we look at sustainability linked measures, that could become more complex in terms of documentation, which itself is driven by regulation. So yes, I do feel that there is more to come here, and particularly what comes out of government is going to be really important.
Thanks for that, Martin. Really interesting to hear your perspective on that from the housing association perspective, and what you're sort of doing to get ready for those changes. So moving on slightly from the, we've started off talking very much about the finance side of things, and aspects of reporting have come into that. But beyond that, beyond finance and reporting, should ESG be a strategic priority for housing associations? And if so, what are the challenges of getting it right? So Martin, it'd be great to hear your thoughts on that, and then we'll come over to Rob afterwards on that.
Thank you, Sarah. In short, the answer is yes. Most definitely. And I think in terms of L&Q's position, we are certainly committed to a framework which demonstrates our holistic approach to ESG. There's a lot of focus on E, but we shouldn't forget the S and the G here. In terms of how we've done that, we've clearly outlined that through our strategic intent, and that's clearly documented within our 5-year corporate strategy, which is called Future Shapes, and thus ESG is implicitly linked to both our vision and our purpose. And when we talk about our purpose, the key areas for L&Q cover service, homes, people, governance, insurance, and financing. And our view is that ESG applies across all of those strands. It is not just a financing instrument. There's a clear remit from L&Q in terms of a focus on environmental sustainability and the climate change agenda. And we are actively doing that through investment in and changes to our ways of working, investment in our homes, and changes to the way that we're looking at our business operations. Now, there are some real key challenges around ESG. I think it's very easy to write a use of proceeds framework and put it out there. Yet, fundamentally, how does ESG fit within your culture? How does it fit within your strategy? Are the behaviors that come out of employees, do they reflect what we're trying to do as an ESG business? And the challenges come around in many different forms. So the first piece is that cultural piece, and that's been a big challenge for us as a large organization that has lots of different business segments, lots of different business strands, and that employs a lot of people. The second key thing is around absolute KPIs. Are they realistic? What are the consequences of not achieving KPIs? What is the reputation risk associated with that? And thus, the key thing for us is, how do we ensure that we can roadmap ESG into our strategies and into our budgets? And therefore, that stakeholder mapping piece has been really important for us. And we are still at an early stage. There's a lot more that we can do. The challenges are going to be around data, for example. There's a lot of focus on on EPC certificates. ESG goes far wider than EPC certificates. So it frustrates me when I just hear EPC being the way forward. It's far deeper and far wider, particularly when we look at things such as modern methods of construction. And for us, when we look at the benefits of ESG, it's not just the benefits that are aligned to financing cost. We need to think about tenancy sustainment. We need to think about our objectives, building better, more quality homes. Therefore, how can we use modern methods of construction? How can we save tenants money through being efficient? Then if we look at the social aspect of what we do, how does our L&Q Foundation, that's the way that we look at communities in terms of social, in terms of L&Q Foundation, that's our remit to address communities from a social perspective. When we look at the governance aspect of ESG, how does that allow L&Q to have stronger and more diverse leadership? So lots of challenges here, but my view is absolutely it goes far wider than financing. And yes, it is a strategic priority for L&Q and it should be for others.
Thanks very much, Martin. Really helpful insight there. Yes, I'd like to come over to Rob now. Rob,
thanks, Sarah, and good morning, everyone. So I agree with what Martin's just fed back there, and I think from the sector as a whole, I think it has grown in importance, and it is seen as a strategic priority in I think all organisations I've certainly spoken to. I think as a sector and from Longhurst's perspective, I think we've been very strong on the S and the G. I don't think we've always told our story as well as we could have done in terms of the contribution and the impact, the positive impact that we have with the work that we do. So I welcome the work that Phil and colleagues did with the reporting framework, because I think that's really helpful as a base starting point in terms of the metrics that have been developed, and having a consistent framework for us to report under. And I think as has been previously said, some organisations will use that as their reporting framework, and others will look to develop beyond the reporting framework that's been issued. And I think probably quite rightly over the last, well, it feels longer, but it's probably more recent. The last 12 to 18 months has been more focus on the environmental side of things, and from our organisation's perspective, I know that's where we've got more of our work to develop the ESG strategy, the S and the G within our Improving Lives 2025 strategy. There's a lot that we're already doing that fits very closely with the social and governance, but more that we need to do around the environmental strategy. And in terms of getting, I suppose, getting it right, what are going to be the challenges around that? Well, I think for each organisation, it's going to be what's appropriate for their business and for the communities and residents that they're working with, and what works in one part of the country isn't necessarily going to be a good fit or work as well in other parts of the country. So from our organisation's perspective, we're quite geographically dispersed, and we know it's not going to be a one size fits all approach. Martin's just mentioned modern methods of construction. That's going to be a key element within that, and there are going to be some things that evolve and develop that mean that we're going to have to flex on our approach as there's better technology and there's better understanding in terms of development and retrofitting in particular. We know from work that we've done over the last 12 months around both new build and also retrofitting that the position that we thought we were looking at a year ago in terms of what the additional costs were going to be looks very different now 12 months on from that, and I think that will change further as more becomes known. So from our organisation's perspective, we're absolutely committed to developing that ESG strategy this year. The focus for us, and it will, I think, be very different for individual organisations, is more on the environmental side, but weaving that all together. And I think with the reporting framework is being able to tell our story better in a more joined up and coordinated way than we have done, and probably I think that's true for the sector as a whole.
Thanks, Rob. And following on from that, you know, as you're developing that strategy and thinking about how it plays out into the finance side of things, as more and more issuers and sectors are adopting ESG labels and going out for funding on that basis, do you think there's a danger that it all just becomes white noise or green noise, we might call it? And how do individual issuers and the sector as a whole then differentiate themselves against that? What are your thoughts on that as you're approaching this task?
I think it's now becoming mainstream. We certainly don't see it as white or green noise, and I think it's more than just a badge or a label for financing. It's around it being embedded within the organisation. It's something within our finance team that we're looking closely at, but within the whole organisation that it's embedded in. So it's not just something that is done within finance. It's something that the whole organisation's signed up to, and I think that's part of the way of differentiating between ourselves and other organisations. And what's relevant to us won't necessarily be relevant to some other organisations, but it's how we mainstream that within our business, that, you know, as part of the ongoing reporting, that we're able to report what we've done and how we've performed against the ESG targets that we'll set for our business, and how it's then linked into to other targets and strategies within the business. There's so many different I suppose strands that will link into the broader ESG strategy. We've just launched our updated procurement strategy, and this is a key part of that. We're currently out to tender for a new repairs contract, and comparing what we did the last time to some of the assessment criteria now, where there is a clear focus around ESG criteria, as well as the other important factors around price and quality. So for us, you know, it's certainly not a tick box exercise, and I don't see that for the sector as a whole being a tick box exercise at all. I think that there has been significant buy-in. The level of interest generated by the reporting framework last year, I think, is evidence of that. So for each individual organisation, I'm sure they'll be telling their story in terms of how they've performed. I think Martin mentioned earlier around data. Data is absolutely going to be really important in terms of how we measure and compare ourselves as individual businesses. But it's more than just the data in terms of the KPI measurables. It's those case studies. It's the positive impact that we're having on the communities that we're working with, and the level of improved housing that we're able to provide linked into to our ESG strategies. I don't think that's probably something we've done enough in terms of our reporting. It's often around how many new homes that we produce as a sector, and I think in future that needs to develop more around the standard and the environmental credentials within those homes that we're developing and retrofitting as well.
Thanks very much, Rob. And I'd like to come back to Phil on that question as well about, is this just going to be white noise? Are we going to stop talking about ESG finance and just call it finance again, Phil? And how do you react to that as a potential borrower?
Yeah, I mean, I think, Sarah, it is getting to the stage, and I've said this to a lot of our clients, where from being the exception to the rule, it will become the rule of financing that you issue debt or take loans in some form of sustainability linked format. And I know the question we've been asked a lot of times by clients is, well, what's the point of this, and is it going to make our finance cheaper? And I usually sort of turn that around and say, well, possibly, but if you want finance, you're going to have to conform with with a lot of these ways of doing things, because it is the way that the market's going. As Chuck said earlier, it's becoming so embedded in the the policies of asset managers, pension funds, and the underlying providers of that capital, that I think it will get to the stage where it becomes near impossible to access mainstream financing markets unless you've got your house in order around your ESG reporting. So I think there is an extent to which it becomes the sort of the mainstream, and I think the challenge for the housing association sector within that is that when you've got companies like BP and Shell and BAT and all the rest of it issuing debt that on the face of it is conforming to the same standards that the housing association sector is, when I think we'd all accept the reality that the housing association sector goes much further in actually delivering on the ground under all of these factors. How do you then go about sort of differentiating yourselves when mainstream financial markets have made that that leap across? And I think some of the and I've had discussions with Martin around this, and he mentioned earlier that all of the sort of default position at the moment is around use of proceeds, which is essentially saying we do good things and therefore of course we're compliant, and you put a framework in place to basically confirm that in accordance with all of the necessary standards. I think one way that the housing sector can go further is to look at sustainability linkage, where you're actually sort of holding, and investors are able to hold your feet to the fire in terms of delivery of certain KPIs that are challenging to the business and challenging the business to push itself in a certain direction. And I do feel that people have got themselves used to the idea of issuing sustainable debt, and have therefore gone for the sort of, dare I say, the slightly easy option in terms of how they do that. And I think the next iteration, in my view, will be leaders within the sector taking that to the next level and saying, well, actually, what we're going to do is set ourselves a really challenging target now in terms of either the environmental standards relating to new developments or retrofitting, decarbonisation, alleviation of poverty, whatever measure you're using, and use that and use the financing as the sort of leverage to push organizational change even harder. And I think that's one way that you'll be able to sort of set yourselves apart as a sector, rather than being seen to be sort of participating in this sort of greenwashing process that people talk about.
I'll just jump in there, Sarah, because there's just from what's just been said over the last 5 minutes, there's a few things to just disentangle and just to perhaps bring a kind of bite-side lens to. So the first thing is, at the moment, across the different real estate components, including the real estate sector and its industries, of which this industry, I suppose, if I call it an industry within the wider real estate sector, is one. We are seeing the overwhelming majority of certainly investment grade issuances having some kind of ESG component to it, whether it's use of proceeds or kind of green projects. So at the moment already, the ESG debt products are dominating the debt space for for real estate generally. And I suspect I haven't got the breakdown for the social housing sector in particular, but I imagine, I mean, Phil probably knows the figure, but I imagine it's already dominating. That's the first thing to say about it. The second is just in terms of the labels being used. I think ultimately the labels help vis-a-vis alleged greenwashing or social washing, in the sense that at least it provides, if you like, a first filter for many asset owners and asset managers looking to invest in something that ties up, links to people's values. Now, that within that, there is of course a discussion as to whether there is general additional impact beyond what there would have otherwise been. That doesn't necessarily mean that the use of proceeds is any less green. It's, I suppose, more a question of whether the use of proceeds would have been green, whether it is an ESG product or not. And in that sense, the impact, the actual impact becomes more of a material issue. Now, there's a challenge here for asset managers, because ultimately what they primarily focus on is financial materiality. So the extent to which ESG factors actually deliver better returns and better value creation within a business. Now, legally, fiduciary duties dictate that that's the ultimate goal. And what your thesis is as an ESG investor is that if you have a better ESG profile, it's financial material and it's going to produce better returns. Now, where there's an ongoing debate generally in this space is the extent to which asset managers can get into issues that go beyond what's financially material into what will actually have positive societal impact, this whole notion of double materiality. And really the only ones who have a direct, explicit mandate from their customers, clients, ultimate asset owners to not only look at what's financially material, but also go much more into what Phil's just been talking about, are the funds in the impact investing space, which is quite a small part of the overall ESG market. And some would argue that actually you shouldn't consider impact funds being within the ESG investing space. You should consider them as being separate. Now, the reality is at the moment, Phil is right in the sense that what we detect in asset manager, asset manager houses, is that whereas 3 or 4 years ago, the ESG team within the asset manager might be like a secondary filter brought to bear on portfolio management. Now it's more of a primary filter. So they're consulted and have a influence right at the starting point of the investment decision. And often now it's not only a separate ESG team that carry out that process. Often there isn't a separate ESG team because all portfolio managers are expected to oversee the integration of ESG in the initial investment process. That's before I even get into the whole stewardship agenda once you've actually made your investment in the asset. So in that sense, it is becoming more mainstream. However, the financial materiality issue is core. Now, probably what we will see 10, 15 years hence is that the same way in which ESG products are seen as fairly niche at the moment, because ESG factors will be integrated across the whole investment universe, the way in which we think about ESG now will probably be the way that we come to regard impact, which will be a bigger part of the market and be more, more of a mature market, but it's not terribly mature at the moment. So that's just to kind of disentangle, I suppose, some of those issues. I think the greenwashing issue is a genuine issue, but I do think the regulations, both from an EU perspective and a UK perspective, which in the end, I mean, for all the talk about we've picked the best, the baseline will be to comply with the EU approach on this, will reduce the risk of greenwashing relative to what it was before SFDR came into effect. Because otherwise, frankly, if people don't pay heed to the new regulations, you're going to end up with enormous liability, and it could be the next big mis-selling story, a mis-selling scandal in the future, and no one wants to be in the middle of that.
Just as an aside, Sarah, picking up the change in landscape of this, and it's an anecdotal one, but we work with a lot of issuers going to the public debt markets with syndicates of investment banks and book runners, facilitating that process. And the ESG structuring role has become the one that all of the banks are fighting over now. It's not about sort of who's leading the investor presentation or documentation. It's suddenly everybody wants to do ESG structuring because they want league table position in that. And there's been some real sensitivities and bun fights over that on a couple of recent transactions, with everyone wanting the kind of the creds and the kudos from that role, which again, 2 years ago, no one ever thought about it. It wasn't
incredibly cynical of you to suggest that.
I'm an ex DCM bank. I can say these things.
But look, I think this is brilliant, right? This is great. This is great. That when I look at we're obviously a universal bank, but the idea that us and our competitors all want to actually do the ESG role on transactions, I just think it's fantastic. You would never have seen that 5 or even maybe 3 or 4 years ago. And I mean, it's true. I mean, not just on debt capital market transactions, but on across the board on big transactions, issuances, whether it's debt or equity. ESG is just like, it is a big material issue now. And it's raised, I mean, the CEO, CFO conversation they'll have with their bankers, whether it's debt or equity, will now include ESG. It's just as a matter of course, it's like a major issue. And I just think it's incredibly welcome because, let's face it, if you look at the debt overhang that we're going to have post-COVID, I mean, the debt to GDP ratio was around 80%, just over in the early 80s before the pandemic. Now we're way over 100. I don't have the exact figure, but the idea that the public sector is going to be able to front up the capital needed to address these societal issues, environment, preeminent, and of course inequality, is for the birds. You're only going to get it if private markets step up and fill the gap. And so all of the things that you're just observing for, I mean, frankly, we need that. We need that. And if you told me we were going to be here, 5 or 6 years, I'd fall off my chair to think that you'd have, investment banks, all kind of vying to be, to have the ESG component if they're joint global coordinators on a big IPO. I just think it's fantastic. I think it's a good thing.
I can see we've got questions coming in from the audience, which is brilliant. So please do keep sending those in. There's one here that picks up on some of the points that Chuka, that Martin and Phil all mentioned there around the kind of the fact that there is this sort of split at the moment between use of proceeds mechanisms that you may see in the bond markets, and then the KPI linked interest rate margin discounts that we're more used to seeing on banking products, and also I think 1 or 2 private placements have adopted that approach. So somebody asks, and this comes back to Chuka's points there about actually achieving impact. Somebody says, could you look at a hybrid sustainability financing model, which is use of proceeds, but is also linked to KPIs for pricing? Why do we have to choose one or the other? So it'd be great just to hear sort of quick thoughts from, I'll start with Chuka and then Phil and perhaps Martin, because I know Martin had some concerns about that on that question. So to Chuka first, please. Thank you.
I don't think in principle that there would be anything to stop you having both components in an issuance. I think it's a question of whether you've got issuers who would be prepared to have both sets of requirements, and would there be a market for it amongst investors? Potentially. And I think actually there have been, it's already been done to some extent. One question I just wanted to, so I hope that provides a little bit of an answer to the question, but I wanted to go back to Phil actually on this issue about labelling and impact. Because I think one of the challenges here, getting more into the kind of impact space and when looking at double materiality, is how do you measure whether an issuer would have been doing something in any event, but are just using an ESG product to, get a better coupon. You know, how do you determine that? How do you make a judgment on that? How do you prove it?
Well, I'm not sure you do. I mean, because if you look at what housing associations have been doing for the last 30 years, I mean, they've been doing sustainable stuff.
Well, I suppose it's a classic example, isn't it? You would do all this stuff anyway.
You've been doing all this stuff anyway, but I think what it's doing is recognizing from a capital perspective that you're doing something that others are not doing, or you're giving some ability to sort of measure impact in a way that hasn't been sort of available before. So I think the question of whether people were doing it before or not is somewhat moot, because that applies to any sort of ESG or impact labeled business. I don't think people are starting to do stuff just because of this. A lot of businesses were doing lots of good stewardship stuff, you know, for the last 10 or 15 years. I mean, just to answer the point, I think this is where the question that's been asked, you have to link the sort of public capital markets and the private markets on this, because, you know, a lot of the, I would say, you know, probably, I'm guessing here, but 60 to 70% of housing association finance is in the bilateral private space as opposed to the public debt markets. And once you move away from the public debt markets, you're essentially into a bilateral discussion between borrower and investor, or borrower and lender, as to how your deal is structured, and they are very bespoke. And this is where you get KPIs that sort of move into all sorts of different areas depending on the business model in question. So I think you have to sort of differentiate between public markets, which need widely accepted standards and conformity, and therefore you generally fall into one bucket or the other, versus private markets, where I think you could do pretty much whatever you and the investor in question want to do and label it broadly however you want to. So
I completely agree with you on that, Phil. I think that's right.
So if I may,
and Martin, please, be great to hear your thoughts as to whether you've got any concerns about those.
I do agree with what has been said here. I think there is a bit of a fundamental concern here when we talk about ESG financing, these different products that are now coming onto the market. It all feels very complicated, and it all feels very technical, and that does cause people to be apprehensive in terms of how they address their ESG issuance. Ideally, for me, I love simplicity. Keep it simple. And we have this motto in NQ: keep it simple because it equals effective governance. You've got to be able to explain things in simple words and in layman terms. When we look at the different products on show, ideally for me, why can't we just have one single product? So yes, that could be a hybrid, but it goes back to the point, what do investors want to invest in? And I think that's a fundamental point here. For us, the way that we are doing this through our ESG financing framework, which will be published in due course, is we will adopt both routes. We will have both use of proceeds and sustainability linked options within that framework. And I think it's important for us as an issuer, probably the largest issuer within the housing association space, that we have flexibility within that framework. And therefore the framework document itself is going to be absolutely critical in to determine which path we may take. I'm a fan of sustainability linked. That's a personal preference, because I like the fact it's for general corporate purposes and it keeps it simple. The use of proceeds route is a very, very good route. And I certainly believe, picking up on one of the other questions that's come in, when we start to look towards net zero, when we start to look at the investment that's needed in existing stock, when we look at the focus of this sector around quality, obviously addressing fire risk and other structural concerns, it could be argued that a use of proceeds instrument might be better aligned to address certain projects, whereas sustainability linked could be better used for general corporate purposes. So yes, a hybrid could happen. We just need one of the banks with one of their role hats on to develop a product that's out there that people are going to buy.
Brilliant, thanks for that, Martin. And there's a call to action for any of the bankers listening. We have a couple of questions that are asking about the different elements of ES and G. So somebody has asked, so Nishant Tiwari has asked, he says that the G of ESG has hardly been probed into, and he says that aspects around equality on boards, etc. Is it all talk and no action? And do we need more focus on the G to hold companies accountable? So that's one question. And then Luke Cross has asked, is there a risk that the sector assumes it has the S and the G covered when actually there's a fair bit of work to do there? So perhaps I'll come over to Rob first for his thoughts on those elements, on actually sort of digging into the S and the G, and then hear some thoughts from other members of the panel that want to come in on that.
Thanks, Sarah. So just picking up on Luke's question first, I think there's a valid point in there that we assume that we've got S and G covered. I think I said earlier that as a sector, I think we've been pretty good around the S and the G, and we've not necessarily told our story as well as we could. I don't want that to be seen as a complacent view, but I think in terms of actual work that's been done already, I think we're starting from a strong position, particularly around the social investment that that registered providers make within their communities, and around tenancy sustainability. I think the last year in particular has seen the value of what registered providers do beyond just providing home and support services. So there's definitely more that can be done, and in terms of ongoing engagement with residents and what's proposed within the white paper, from our organisation's perspective, we welcome that, and have recently established a new customer forum to improve connectivity with the board. And then around some of the governance points, I think, and again, it's from where your starting position is, but from what I see across governance in this sector, I think there is good engagement around diversity on boards, and seeing that as something that's absolutely bought into, rather than something as a tick box exercise. But again, there's more than can be done that's already in place. And Luke's also, I think, referenced some helpful points there around risk management, executive pay, supply chain as well. So I'm not absolutely saying that we're not there yet, but I think we're in a good starting position. But Luke's absolutely right. There is a risk that we focus more on the E rather than the S and the G. And from Longhurst's perspective, we think that's appropriate, that we need to spend more time on the E at the moment. But that certainly doesn't mean that we're taking our eye off the S and the G. From our organisation's perspective as well, on governance, we've got a good mix of board members, and that's something that we've been very focused on in terms of both skills and what those board members bring, but also trying to make sure that they're more representative than probably has been the case in the past. So comparing our sector to other corporates, and with the governance code as well, I think there's a lot that the sector can be proud of in terms of progress that's been made already, but certainly more that can and should be done as well.
Thank you. And Martin, did you want to come in on that question as well?
Yeah, I think I'll start with Luke's. I think he makes a good point that we can assume the S and the G are covered. There is a lot of work to do there. We've seen that through developing our own framework. There's a huge amount of work to be done on both of those aspects. One of the ways, for example, we may look at the S is to measure through the HACT measure. That's potentially one route that we will potentially look at. For us, we've also got our L&Q Foundation. We do lots of work through that. A huge amount of work goes into the L&Q Academy. So yes, it on the face of it, it feels like it's already there, but it's that point of being able to present that to a wider audience. And this to me is where the framework becomes really important in terms of how we disclose that to a wider audience and how we report on that. Totally agree in terms of other stakeholders in Luke's question. Engagement and that resident voice. Look, this is a huge piece for the wider sector, and for us, we've made absolute commitments, and we've actually adapted our governance structure to ensure that the residents' voice is heard. And our commitments are to increase openness, transparency, accessibility, and accountability. And I think that's really an important point from governance perspective in terms of having that residents' voice that is heard. We have residents on our board. Going back to the diversity question that was asked, yeah, I think that one could argue that companies kind of do more talk and have no action. For L&Q, that is certainly not the case. Diversity and inclusion is a huge part of our culture. And what we mean by diversity and inclusion is a different voice, is different ideas. And for us, when we look at our representation across senior management, and if we look at that across our executive and our board, we as an entity are certainly well represented through diverse leadership. And one of the things that we have done within L&Q is adopt the Rooney Rule. That's an announcement that we made back in 2018. So my view is that we are seeing action, we're seeing positive action, and definitely for L&Q, diversity and inclusion is a huge part of our culture.
I'll just jump in there. I just totally disagree with this idea that G has hardly ever been probed into. I just don't, I think that's plain wrong. In fact, the starting point when ESG became a phenomenon, we all used to call it ESG, the part of ESG that investors were most kind of agitating around and interested in was the G part. I'd then say after that, the environment became a very big issue. Perhaps sometimes some would argue bigger than the governance issue. And then, of course, COVID turbocharged the S part in ESG and kind of brought that up to a level with the rest. So it's simply not right or accurate to say that the G has just been forgotten about. That's my first point. My second point is just in my experience of dealing with the sector, and particularly during my 10 years as a member of parliament, I had over 25 estates in the constituency of Streatham where I grew up and had the privilege of representing. By no means is the governance of housing association boards perfect, but my gosh, they are far more diverse, both from a gender, ethnic and socioeconomic point of view than the boards of most other large corporations in this country. And that is absolutely worth stating. And of course it should be better, but it's streets ahead of many other industries who are only just catching up on that front. So, and I would say, you know, for investors now, I think actually across the board, all three really matter. And there's a big debate in, you know, as to whether ESG delivers alpha, so whether it delivers outperformance relative to the rest of the market. But in a way that kind of misses the point in terms of its original purpose, which was to act as a proxy for prudent risk management for investors or good management. You know, a corporate, whether it is a social housing trust or large UK PLC with a good ESG profile is indicative to investors that this is a well-managed operation, and not only just well managed, but also takes the long view and into consideration external shocks and risks. And that's why, on the whole, during COVID, all the research shows that the organizations with better ESG profiles weathered the storm more effectively and proved to be more resilient, because they operate taking the long-term view, looking at externalities, other stakeholders, and therefore better set up to deal with these external shocks. I kind of just want to speak up for the sector, not necessarily myself being part of it, because I think it's totally unfair to start knocking it on the G side. You know, look at the facts and then come with a judgment.
Brilliant, thanks for that. We've just talked about the other elements of ES and G, but I've got a question here that takes us firmly back to the E, which comes back to the net carbon zero challenge. So somebody asks, one estimate is that around 80% of the properties that will exist in 2050 will have already been built. Do registered providers have to be heavily focused on decarbonisation and retrofitting their existing homes? And sort of crucially for this discussion, how can this best be funded? And are specialist finance solutions required in existence, or in existence? So coming back to that question about the sort of development of products going forward. So who'd like to jump in on that question?
Shall I have an initial go? Because it
Brilliant,
is, I think, the sort of elephant in the room, you know, not just in the housing sector, but in many other areas of the economy as well. And I think for housing associations in particular, those that have built up, you know, large estates of assets over time from, you know, mixed eras in terms of build quality and all the rest of it, it represents a sort of a huge financial challenge at the point where the sector has already kind of geared itself up to a large extent on the back of falling grant, and is, you know, has sort of moved down the spectrum in terms of credit ratings and you know and credit ratings related metrics. So the idea that from this point you can expect housing associations to undergo another sort of huge taking on of debt to finance this on balance sheet, I think is you know, it's potentially possible, but probably the flip side of that is that you have major cutbacks in new supply and expenditure in other areas, because something's got to give on this. And so I think there is an opportunity to look at sort of specialist financing solutions around this area. I think it's almost going to take a sort of, I wouldn't call it this, but a sort of special resolution type deal. And we don't know at the moment what the government's proposing in relation to this. The government's obviously sort of imposing the targets as part of its overall commitments. And therefore, if it just hands them down to the sector will respond accordingly. But you won't see a lot of new housing supply, in my view, over the, you know, the coming decades while it sort of resolves that problem. So I think the you know, the sort of private capital, and Chuka referred to this earlier, that you know, government, there has to be a limit to how much of this it can sort of take on its own shoulders. I know at the moment that doesn't seem to be the case, but I'm sure that sort of trend will change at some point, and we'll be back into the, you know, living within our means type mentality. And so private capital is going to have a very large role to play in meeting the decarbonisation agenda. But my personal view is that you have to take at least part, and preferably a large part of that, off balance sheet in some way, and come up with the financing mechanisms to allow, if you want to allow housing associations to continue providing excellent services to customers and providing new housing supply. I don't think it can do all of these things at the same time in the scale that's being expected of them. But I'll let Martin and Rob comment from a sort of expert practitioner's perspective on that. They look more closely at the business plan numbers than I do.
Thanks. Yeah, let's go over to Rob next for his thoughts. Thank you, Phil.
Thanks, Sarah. So I think in terms of the two issues, the retrofitting agenda is certainly the more complex and challenging in terms of how that's financed in the future. and I'm sure Martin's in a similar position in terms of work that he's doing in terms of profiling what the cost is, and also how that looks under certain business plan scenarios. But it's also what sort of investment and what sort of changes are made to retrofitting, and some of the analysis that we've been doing at the moment actually leads to increased costs for customers in terms of fuel costs, and from a health and well-being perspective, which is one of the key parts of our strategy, that just doesn't fit. So we're looking at a number of different scenarios around retrofitting that achieves the zero carbon agenda, but then doesn't leave customers with higher fuel bills in terms of installation of air source heat pumps, as an example. But then there's the cost of doing all that as well. And whilst the numbers have
I think we might have just lost Rob there, or I have at least. So I'll just come over to Martin for his thoughts on that question.
Thank you, Sarah. Look, I think as Phil said, it's the elephant in the room, and definitely from an L&Q perspective, what we've seen in our corporate strategy is a fundamental shift from development and kind of trying to hit numbers back into investment in our stock, and that's certainly where the budget allocation has gone to over maybe the next 3 to 5, maybe even 7 years for us. So it's trying to balance these things. Now, obviously, there's likely to be a call on government. I don't think we should always turn to government to bail out this sector. I think if we look at the balance sheet of the sector, there's certainly latent capacity within the balance sheet of the sector. We need to look at a number of mechanisms to drive efficiency, and actually ESG is a big part of that efficiency agenda. So for me, when I look at net zero carbon, I think firstly we need to totally understand what that means for us. It's not just that, COP26, other acronyms that are coming into this sector. I think in terms of financing, Phil was right. How do we balance up this pleasing investors through investment grade ratings, and yet having investment to do in our existing stock, yet being under pressure from government to deliver more housing? Something has to give, and the solution to that is likely to be some form of off-balance sheet financing in the future.
Thanks very much, Martin. Just
Sarah, could I just make one more point there that I think is peculiar to the housing sector, and Rob's touched on this, albeit in a sort of slightly different way that I would have tracked, but it's really about the linkage between the resident sort of outcomes in terms of fuel cost and fuel efficiency versus the expenditure. Because when you look at this in most other sectors, the costs of retrofitting or decarbonisation often sort of flow through in the form of power purchase agreements or whatever that allow you to effectively sort of match the two off over a long period of time through a project finance type structure, where you'll say, I'm spending lots of money now, it might be someone else's money, and I'm paying them back through lower energy costs over time, or a fixed energy cost. And you don't have that linkage in the housing sector, and that's what makes it really difficult to think about financing some of these measures. And that may be one of the policy sort of changes that's needed going forward in order to try and sort of make the whole thing stack up. But anyway, I just wanted to make that point as well.
Thanks, Phil. I'll just go briefly back to Rob to finish his point, and then I'll come to Chuka with a final sort of rounding up question, because we're almost out of time. So just over to Rob briefly.
Thanks, Sarah. So just one final point from me before I lost connection, and just picking up on that last point from Phil. I mean, the fuel poverty point I think is really important for registered providers to be looking at, and I agree some form of off-balance sheet financing will need to play a part of this. But we also need with government to be looking at a different rent standard for the future. Certainly the social rent model now is so far out of date in terms of a formula rent based on on January 99 values when we're now building homes which we would never have been able to build in sort of the 90s, and the level of investment that we're going to retrofitting. How do valuers, a number of which I'm sure are on the call, apply a retrospective valuation to calculate social rents where we've still got them in place?
Thanks, Rob. And yeah, as I said, just we're pretty much out of time, but I'd just like to come over to Chuka with a final question to end on today, which is what does the current state of play in terms of sector adoption in general of financial products around ESG tell us about what the next phase should or might look like? Chuka, just your brief thoughts on that very tricky question that I've thrown over to finish on.
So I'd say that given it was a kind of general overall question, I suppose, I think we will continue to see the record inflows into sustainable and ESG funds that we saw in 2020 going into 2021. In terms of the kind of absolute levels, there was a little bit of a dip relative to last year in some aspects, but the inflows have continued to go in. There's been a question around performance this year because ESG and sustainable stocks are quite heavily invested in tech. Tech hasn't done very well in the first quarter of these years, whereas energy, which the ESG and sustainable funds tend to exclude, has done much better. But I think the long-term trend is going to continue. And I suppose my last thought would be, I think investors underestimate how important not only demanding that issuers and corporates reach net zero and come out with intermediate term targets and roadmap, but I don't think they have given enough thought to the need for there to be a just transition and for us to sort out the way the economy works, lower the cost of living, for example. And I think that's where this sector really comes into its own, because it's providing the real essentials in life, a roof over your head at an affordable cost. And if there isn't a cost of living issue, that is that, I don't know what it is. And so in that respect, I think the role that this sector has got to play in the reconfiguration of capitalism, is absolutely vital. So I think there's huge opportunities, both from a value perspective, but to do good, to use the cliche here, which is why it's so exciting and it's a good place to be.
Brilliant. Thanks so much for that, and a great note to end on, I think, that rallying call to the sector and beyond to do the right thing. We're out of time, slightly over time. Apologies, I got carried away with such a great discussion. But I'd like to thank all of our speakers so much for their insightful contributions. Thank you to Chuka Ramuna, to Rob Griffiths, Martin Watts and Phil Jenkins, and thank you very much to Winkworth Sherwood and Louise for putting this event together, and of course to our audience for all of your questions as well. Thanks very much and have a great day.
Thanks a lot.